please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Commodity Champions. I'm Manisha Gupta with your weekly roundup from the commodity space. And what a week it has been for this sector. Despite favorable fundamentals, the metals were pulled down thanks to the tariff war by the US. It all started with US imposing tariffs on steel and aluminum. The Trump administration imposed 25% tariff on steel imports and 10% tariff on aluminum imports. This unsettled the major exporters like China, Japan and South Korea. While their industry called for a retaliation, it was detrimental for the metal prices as steel prices went down by 7% this week, while aluminum is down 2%. The country that produces half the world's steel, China, said that they will assess the damage caused by the move and will firmly defend their legitimate rights and interests. However, the NAFTA countries were helped by the exemptions granted to them. So how will this impact the metals going further? Will the uncertainty continue? To answer these questions, we have with us Jonathan Bharat, economist and CIO of Ayers Alliance. We also are joined by David Lennox, who's resource analyst at Fat Profits. Gentlemen, hi, thank you so much for joining us. Jonathan, coming to you first. Quite a week that it has been. The US finally has pressed ahead for the import tariff of 25% on steel, 10% of aluminum, and that clearly has seen a lot of bristling coming in from the other countries. How do you see the metals now taking it in?
Nisha, quite interesting. I think obviously we're seeing a lot of the metal markets under pressure, there's no doubt about it. The question is whether or not that's tariff induced or whether or not it's just a function of supply and demand. We've had a good long period of bullish prices, and now we're seeing a correction, and a correction with some good solid Chinese data behind it that suggests prices will go lower. So I think, if anything, on the tariffs, still need more time to assess what's actually occurring, but I think some of the commodities are actually trading by their own.
Jonathan, we already have seen a knee-jerk reaction on the metal space in this week with the kind of dip that we are seeing in the sector. Do you see anything worth buying right now, or would you rather stay on the sidelines?
I think we have to really sit on the sideline a little bit. I think we've always talked about being positive 2018 for a lot of the metals. I think when I do come back and look at the tariffs quickly, I always get a sense that, there are winners and losers, and it's just that the losers will always go and try and find another market if they get upset. So when I look at where the metals markets are trading, particularly obviously the base metals, and we're under pressure, I'm viewing this little correction as something that could go a little bit deeper. But at the end of the day, we're still optimistic that the global growth, which we predicted at the beginning of the year, will actually maintain. And then all those inventories which we're starting to see, remember, we are seeing a lot of building inventories at the moment, that will dissipate and we'll find a good low from which to buy from.
Well, that is what the markets also are, anticipating for, Jonathan. But David, getting you in the conversation as well, while the whole US import tariff thing is almost done now, how have you read it and where are we headed from here? And how will that impact the global trade from here on?
Oh, good morning, Manisha. Certainly, if you have a look at the rhetoric that's now coming out of the US, it would in fact suggest that we've still got a long way to go before we get all this sorted out. Yes, there are now exemptions available to various countries that perhaps yesterday weren't. So that puts uncertainty almost straight back out to play. Overall, we do think that countries will certainly be retaliating if they find themselves on the 25% steel tariff list and also the 10% aluminium list. There's no doubt about that. The rhetoric that we've heard from those countries is certainly leaning that way. But now, of course, it's been softened with the ability for countries to apply for exemptions. So really, we're back at square one. The uncertainty is going to remain until such time as we just know where those numbers and those countries that are going to be impacted are actually aired.
So, David, while you did see that there are concerns about the global trade war right now, would you say that the initial impact now is into the prices, and we perhaps, as Jonathan also mentioned, that going forward we will start seeing the basic demand fundamentals and supply start coming back into the prices, or would you also say that we are still some time away from all of that?
Look, it's certainly going to be a fairly long, drawn-out affair, because we do have to just see what countries do get put onto the list. We have to see those countries that are exempted, and of course, even the tariff amounts may now come into question. Some countries may not face 25% or somewhat less, but one would have to suggest overall, if we do see an out-and-out trade war between some of the major trading blocs, such as the US and the Euro, then we would expect to see commodity prices, unfortunately, in that environment, starting to suffer as concerns over demand does start to wane. However, having said that, it then will come down to perhaps whether or not the US is on the winning side, or the European Union is on the winning side, and then what their currencies are doing. If the US dollar starts to fall, that's going to be a constant tailwind for the commodities, and that could push them higher. But of course, if the euro starts winning and we see the dollar starting to rise, if we see the Americans winning and the dollar starts to rise, that's going to cause problems for commodities. So look, overall, Manisha, we really still are in somewhat of a fuddle as to where all of this may head the commodity prices.
All right, so both of you really are saying that this is just the beginning, and we perhaps are looking at more pain to still come in for this space. But Jonathan, where do you see a more stronger micro fundamentals, because we are looking at a strong demand quarter for metals coming in as we get into April. The Chinese imports have not been so positive, but exports definitely have been good. And then there is this whole EV demand story, the strong global synchronized demand. Do you see all of those stories still stand, and where do you see the metal prices then taking support?
Well, I think when we've seen this rally in the metal market, we've always seen an influx of inventories. Where the inventories, whether it's copper, whether it's nickel, zinc, or whether it's iron ore, we've seen this massive build-up. In fact, as you know, with iron ore, we're at record levels as we speak. Obviously in China. So I guess at the end of the day, we're saying, well, with these inventories levels, how quickly can they actually draw down? And given the economics which we're actually seeing, how fast, and then will momentum start to pick up? When I do look at the metal markets, I've always liked copper, but we are seeing inventory builds there. And I think, if anything here, this is more of a corrective trading regime that we've got at the moment, and then we will find a low. Remember, we're still in a contango, still positive. So I think when the dust settles, when this tariffs situation gets out of the way and we know where we are, if there are no retaliations, then we don't have an issue with global growth, then I still like copper, obviously quarter one, quarter two, starting to find that low and then starting to pick up.
All right, so copper is a favorite emerging there, and the fundamentals are still strong. But David, what is your sense now? Are you also looking at a stronger bullish fundamental picture going forward from here? And how far do you see it? I mean, like a month, 2 months before we start getting back into the strong fundamentals yet again?
Certainly, yes, you're right there. We are now seeing that synchronized growth around the globe. It's something that we haven't seen for some time. And that's really brought the commodity prices into focus, and we've seen the prices adjusting to that very factor. The trade war or the tariffs, that's put an uncertainty into the market that we didn't have just a couple of weeks ago, and that is in fact now starting to just overlay somewhat on that synchronized growth. Of course, if we do see an out-and-out trade war, we're not sure whom is going to be involved apart from the Americans we know are going to be on one side, and just the impact that war may have in terms of growth within those countries that are going to be put onto the tariff list. So again, it's really going to be a matter of watch and see. But one would suspect, given the history that we've seen when trade wars have occurred before, that unfortunately there's just going to be no losers. We will see global growth probably decouple as those countries start to suffer, and that's going to cause pressure for commodities. But overall, that could take some months to play out, and we'll be watching as obviously that does start to move through.
Well, that doesn't really sound so good, David, when you say that we could be looking at decoupling of the synchronized global growth. That would really mean some more pain coming in for many of these asset classes. But Jonathan, while the U.S. import, of course, has been one issue, there also is the ECB now signaling a gradual policy normalization, and that seems to be weighing on the metals as well. So on one hand, you have North Korea president pledging to refrain from further nuclear missile tests. So there really are various things moving in the global markets. What are you latching on to right now?
When I look at what's happening with the ECB in terms of their normalising, that's something we've seen for some time, particularly in the States. When I see what Trump's doing with Kim, I think they're a little bit odd with that, because that's suggesting that Kim is more of a focus than anyone else to Donald Trump. So I guess there's a little bit more volatility, but if it sort of reduces that global fear, then we'll see, obviously, that geopolitical risks start to dissipate for the precious metals. But at the end of the day, I'm still focused on price pressures, given we've had interest rates low for such a long time. And I see that inflationary, or that price cycle, starting to build back in. And as a result of that, when I look at gold, I actually think that we're getting at a lower end for gold, to which I think I'd still like to buy. We're currently long the metal, and we're looking at those dips to buy some more.
All right, that's a view coming in from both our guests, that there is some more pain coming in here. The fundamentals are strong, but there is uncertainty on how longer can the U.S. tariff impact play on to the markets, countries and the metal prices as well. David, coming to you now, there is an expectation that the steel tariff will hurt oil and gas industry also. Of course, changes like tax reforms means that the business environment might stay positive. What is your own sense now, and how much would you look at the crude oil fundamentals in itself, and how would the steel tariffs actually impact or really impact the ground level?
Look, certainly the oil fundamentals will play a key role in continuing to drive the prices, and that is we do expect to see greater demand coming out of the US this summer as we move into their drive season. So that's going to put pressure, we think, on the positive side for the oil price. Yes, domestic production inside the US is rising, but we do expect to see demand inside the US moving at a quicker pace as we start to move into the summertime. So that's going to, we think, drive the prices. As for the steel, yes, it is used inside the oil industry, primarily when it comes to certainly new developments and new fields. In terms of the existing operations, most of them can survive without too much input from the steel sector. So we would expect it's only those new wells that would be coming on stream post the tariff implementation that will hit somewhat higher costs for development. So otherwise, we think for the oil sector and for the most of the companies, life's just going to go on as usual.
Okay. Jonathan, what is your sense on the crude oil prices? Because apart from what we are seeing in the global markets, the macro, that is, the U.S. industrial output, or rather the crude output, has been increasing to record highs as well. Do you see that adding pressure to the prices going forward?
Well, I don't. I can see that we've got the leverages, the supply and demand leverages. You know, when I see the US pushing more oil into the market, I also see it continuing to drop off from Venezuela. We've still got a few issues there in terms of pipelines in Libya. But when you look at the whole equation, I think for global growth, we just need to see the price of crude remain in a range. So I'm more adopting more of a range trading style of attitude. And my lowest end of the range forward would be about that $57 on the WTI, and the top side obviously around about that 63 level. So I think I'd love to see oil in that range where I can take advantage of just range trading opportunities.
Jonathan, one would have believed that with so much uncertainty in the global markets on what we have seen in sense of currency, the equity market sell-off, the U.S. tariff import, etc., and the weakness in U.S. dollar, you would expect the gold to attract some money. That clearly hasn't happened.
Clearly, there's no doubt about it. I think the markets just basically just decided not to focus on it. I think when you look at the way gold is behaving, from a fundamental and technical view, it's just holding ground. Yes, we've been under a little bit of pressure, but nothing too major. And I think when I do look at it from a technical background, it is actually still quite supportive. You know, and I actually think those dips still are quite reasonable. I just think it's really investors have lost or they're moving to other investments. So I think gold's lost its shine a little bit, but perhaps that's the time when you should be looking at it, when the market's not focusing on it.
Well, yes. David, many people have been bullish on silver prices, but it refuses to budge beyond that $17 mark. And as Jonathan is pointing out, gold has been a surprise. It hasn't budged on the higher side. But are you looking at these current levels as a good buying opportunity?
Certainly the one big surprise has been gold. One would have thought with the turmoil that we've seen with the announcement of the tariffs in the US and the trade wars that could emanate from that action, one would have thought that safe haven investments such as gold would have been where investors were looking. That doesn't appear to have been the case. We are aware that over the course of February there were significant sell downs of gold out of the ETF funds, which has placed some pressure on the gold price. So that's likely to continue for the short term and put further pressure on the gold price. However, again, it's really going to be the outcomes that we see from the final tariff lists in terms of who's on it and who's off it and who's going to retaliate and who isn't, that really will, we think, determine just how much safe haven investors will be seeking, and they'll then start to move towards gold. Silver, it's really dependent now, we think, on the synchronisation of global growth, and with that, the increased activity in the industrial sector. That particular, as silver has a big content of use in the industrial sector, if we continue to see the sector growing, then that's going to bode well for the silver price.
So we still are waiting on that safe haven money to come into the precious metal prices. But David, while you said that it has been a surprise, Jonathan, what is your sense on gold and prices, silver prices going forward from here? Are you working any numbers? Are you still sticking to your projections that we perhaps could be looking at a bullish year in 2018?
It's certainly likely on the gold market. I'd like to see, obviously, around current levels actually hold, but at the end of the day, I'm still looking for about a 15% through to 20% rise towards the later half of the year. I still feel that we've had issues in terms of the fundamentals and the technicals, but the market's decided not to focus. But I think they will as the year progresses, and that's why I'm looking for those returns.
All right, so a possibility that the 15% gains in the gold prices could still really come, as we are looking at a lot of uncertainty in the global markets there, whether it is equities, global trade wars, or of course the currency play. But that really brings me to my next question, Jonathan. How would you look at the currency play impacting all of this? Because we already are in the month of March. There is more than 90% probability of a US rate hike in this month. How are you looking at the rates going forward? How do you see that impacting commodities? Because not just US, in this week, we've had monetary policy meetings from ECB, from Canada, from Japan, and from Australia as well.
Well, I guess obviously when we do look at the metals, obviously whatever the US dollar does will affect that. We look for other outside influences, obviously, to help dictate more of a range for the metals. But when I look at the US dollar, generally rates moving higher. People are saying that it should be positive US dollars go up. But I'm more inclined to want to think that, this cycle is changing. Therefore, we'll get disinvestment out of the US, and then it'll move to other parts of the economies. So as a result of that, I'm more of a bearish, have more of a bearish outlook on the US dollar, which also goes to help support my positive commodity outlook. So I think that people that are invested in the US will say, okay, the cycle's about to change. We're going to start to move our money away from there and sort of either bring it home or to other outside investments.
All right. So just to summarize on what both our guests are telling us today is that they still feel uncertainty to prevail when it comes to the metal space. Crude oil prices are expected to trade range-bound. It is a buying opportunity perhaps in the precious metal space where gold and silver are up for takes. And it definitely does look like a bearish year for the US dollar going forward. So that perhaps actually could turn around as a big positive when it comes to commodities and other asset classes. Well, thank you, gentlemen, so much for joining us and giving us your sense on what really can be expected from the international markets for the next week. But with that, it's a wrap up on this edition of Commodity Champions. Thank you for watching.